All right, the market wrapped up the week on a little bit of a negative note. Little small declines going into expiration. Still very small compared to the rally we had going into it. The middle of this, pretty much going into the earnings that we had this week with Tesla and Netflix, especially. So the markets just basically continued, but to a much smaller degree. Yesterday's bearish levels. So no big deal there. The question is whether it will turn into something more. And there are some technical patterns developing that I'm going to break out and talk to you about and kind of give you my sense. I am going to be gone next week. We're going on my 25th wedding anniversary cruise with my wife up to Norway. And so I won't be doing a market outlook video over the next week. Like I said, next Monday, Wednesday, or Friday. Brandon will still be doing it on Tuesdays and Thursdays. And then the Monday and Wednesday the following week, I'll still be gone. We'll be getting back late that Wednesday night. So you won't hear from me again until for 2 weeks. So I'm going to kind of break down kind of what I expect to see, what I expect will happen over the next couple of weeks. By the time I get back and we have this video again. Talk about why, what's moving the market, some interesting moves in different asset classes that not necessarily what we want to see right now. So we'll look at that. And then we'll take a trade in a stock that was very much in the news today, one of our earnings announcements, and we'll see if it started its own little consolidation pattern, how we might be able to trade that. So let's go ahead and get started. Today is July 21st, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at Market Scholar over here at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these things on the right, including our Market Outlook live video. Come down to the bottom and click on this heart. It opens up this tab. Hit that like button there. Also, same thing, click the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers. It's a real big deal for us. That's why we always ask every day for those likes. And our goal is to get to 100, and second straight time we got really, really close. So thank you again for those who like these day in and day out, and those keep doing it, please. And those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we had a second. I guess we finished with a small update, about as small as you can get, but down from the open, 2 consecutive filled-in candles here if it didn't end up being lower by the end of the day. I did bring the near-term line down, as you can see, down into oversold territory, or at least, into bearish territory. The oversold line is at 20th percentile or lower, which is where the momentum line is. So again, like we talked about before, this intermediate confirmation signal where you have the momentum line in the reversal zone, and then you have the intermediate line in the upper reversal zone. That combination with an oversold near-term line is a bullish intermediate confirmation signal. Well, it appears that we got that. We didn't quite get that yesterday. The near-term line was still there around the 57th percentile. But we have had that today. So this is a bullish intermediate confirmation signal. You would expect it to rally up from here in the very short term, very, very short term, as the momentum line bounces back up, right? Because it doesn't generally stay oversold for too long. You can see some of the other instances it can, but it generally doesn't, at least not when you're in a bullish market. You notice the intermediate line is still very strongly bullish, still way up in the upper reversal zone. The market sentiment line is still rising in the upper reversal zone too. So the trend is still strongly bullish, and the short-term sentiment hasn't changed that yet. So again, you would expect a little bit of a pop, at least on Monday, if not Monday, Tuesday, with the rally heading, with the near-term line bouncing back up, the momentum line bouncing back up. After that, how long it stays up is a question. Of course, another down day on Monday towards the moving average, and that's the issue. See, you typically get these intermediate confirmation signals a lot lower to the moving average. We're still over 2.5% above that, so it won't make it impossible for us to rally up. It just will limit any kind of upside we might have. As like I said, 2.5 is already a pretty decent move considering, right? Considering how much, how long we've been bullish. Remember, we've been bullish now for going on 4 months. We're going to be heading into our 5th month here once the calendar turns to August. So that's a long cycle for this particular intermediate run. Let's take a look at some of the other indexes first on their daily charts. There's your NASDAQ. This is a little different story. This is the worst short-term sentiment the NASDAQ has seen. Last time we had it this bad was the beginning of May. We ended up getting a kind of a bull tag there, and then we bounced, right? We bounced back up to a cluster, and then we kept going. So we'll see. There's the intermediate line, market sentiment line are both falling, but they're still both inside the reversal zone. But, again, extreme low on the near momentum line. You pretty much got to the 5th percentile on the near-term line, which is the lowest it's been since way back over here. And that was the 7th percentile. In fact, it hasn't been at the 5th percentile for a very, very, very long time. And over here was 7th percentile as well. And then over here, of course, it was the lowest when it was under the 1st percentile. So needless to say, that's the kind of bearish short-term sentiment that typically kicks off a bearish intermediate run to the downside. So keep, especially with the intermediate line crossing below market sentiment. Now it's crossing below market sentiment like it did here before, but still in the upper reversal zone. So it's not necessarily a bearish sign quite yet. You can get lots of crossovers in the reversal zone. It's getting back down out of the reversal zone is when things really start to. But again, the short-term sentiment that bearish, like I said, you just haven't seen for quite a while on the NASDAQ. And you've had some bearish declines. I mean, that was out of June expiration was a pretty bearish decline, and you never did get bearish sentiment this bad. Over here, coming out of May expiration, we had a pretty bad bearish sentiment, and that didn't get this bad. So it's a little bit more bearish than normal on the blue and red lines there. Your Dow Jones Industrial Average, again, coming off a cluster from just a couple days ago. You can see the near-term line is still in bullish territory. It's out of the reversal zone. Momentum line slightly oversold. So again, technically, you have a bullish intermediate confirmation signal. In this case, your near-term line's not below 50 or in bullish bearish territory. So you wouldn't expect the market to rally. In fact, considering that we just went parabolic here in the short term. So it's not, Dow hasn't been parabolic. We'll come back to this in a minute, but the Dow hasn't been necessarily parabolic itself. Well, I guess it kind of has now. It really spiked up this past couple of weeks up to 40 in the negative indicator down. But if I were to break this in half and kind of look at the short-term move, then you can see, here I got to get rid of the labels. Sometimes it showing these kind of throws it off. There we go. So you can see we did get up above 50 on the near-term line. The ADX is way high, so and the negative indicator down. So we pretty much have gone parabolic here going into expiration on the Dow Jones Industrial Average. So that I wouldn't expect us to bounce off of this intermediate confirmation signal. In fact, I would expect potentially the momentum line to stay bearish with the near-term line dropping. Down to these bearish levels like the other indexes. Your Russell 2000 is kind of in the middle, right? It's more bearish. The momentum line dropped to extreme levels, down below the 5th percentile. The momentum line dropped down to close to the 20th percentile. So kind of in between where the NASDAQ is and where the S&P is. So again, a relatively bearish close across pretty much the broad spectrum, right? The breadth of the major indexes there. So again, more bearish than what we've seen. Let's take a look at their weekly versions of these charts. Let's go back to SPX and look at its weekly market forecast. There we go. So again, you can, you can see here that the intermediate line on the weekly chart still in the 90th percentile. A little bit of a long upper shadow there. Near-term line is in the upper reversal zone. Momentum line stuck in neutral. So we're still kind of persisting on this bullishness. Nothing too extreme in either direction. for the S&P. Your Dow Jones Industrial Average got a cluster this week. That's how bullish the Dow was. So keep that in mind in terms of just how bullish we are right now. The Nasdaq 100 obviously did not get a cluster, and its near-term line has been dropping as the index has been rising. So convergence mode with the momentum line dropping too. Not quite consolidating. We're not in bearish territory, but we are dropping as we've been rising, and way more of a long upper shadow on the Nasdaq with a little bit of a bearish candle there. Finally, your Russell 2000 obviously did not get a cluster either. It's still stuck below its February and August peaks. The intermediate line is just barely getting into the reversal zone or into bullish territory. It's been lagging behind the near-term line, setting up right now for a bearish divergence right now. So that's something to keep an eye on. Let's look at the other weekly chart that we take a look at, and of course a higher high and a higher close is great. Now the question is, what's next week going to look like? So right now we're going to open around 44.80, 44.85. We're trading at 45.36 right now. The close, the Hakunashi close, is 45.32. So we're going to have a small body, probably back below the moving average. And the question will be whether next week we close above or not, and whether we get an upper shadow, a long upper shadow, or lower high point. So as of right now, these weekly, especially on the Dow, very, very bullish. The Dow, I mean, this basically a bullish breakout pattern because we had been getting 4 weeks of transitions, unable to get above that Hakunashi close. But today, or this week, busting out. Again, with a cluster, with a pretty decent sized candle too, one of the bigger candles that you see. So a pretty decent sized candle there. Now it's like, okay, that can't be a fake out pattern, right? Your Nasdaq, on the other hand, again, bullish, higher high, higher close, very strong PPO here, higher high and a higher close there. You can see it's just not the biggest body, and the question now is, what's next week's body going to look like? We're going to open the midpoint of the body is where you open, so you're going to open right around 15,370-ish. We're already trading at 15,425, which is well below the close. So the Nasdaq is setting up for a transition candle next week. So that's something to keep an eye on. Your Russell 2000, like the Dow, real significant bullish move. Again, one of your biggest weekly candles on the Russell 2000 that you'll see. Now the question is whether that is indeed a breakout. Higher high, higher close, easy. You're going to most likely get, at least at the start of the week, another bullish candle next week. But we can't, like the Dow, that can't be a fake out pattern. We can't immediately turn, if we immediately turn into a transition next week, that's not the kind of move we want to see. You can't get, like, it was like this one over here, where you finally got your breakout after a big, long sideways action. You finally get your breakout only to immediately go into transition, and then this whole thing started. So that's not something we want to see. The Nasdaq is poised for a transition candle next week. We really don't want to see that in any of the other indexes. Otherwise, things might get more ugly than what we've seen in a while. You're still got 3 green arrows across the board, except for on the Nasdaq. The Nasdaq did get a red arrow, so everything else is still green shading and has been. So you're still okay. The Nasdaq, you'll notice, while the S&P is still easily above the 8-day moving average, your Nasdaq actually closed below the 8-day. But that's it. I mean, as bearish as we've been the last couple of days, and we haven't been that bearish, but as bearish as it seemed, especially considering all the chatter and what you hear on the TV, it really, we're just barely below the 8-day exponential moving average, which is not very far to the downside. There is a red arrow, but we don't really worry about significant moves to the downside until you break that 17-day, the second number in this MACD, and we're not there yet. We're not there yet. Your diamonds, you're way above the 8 and 17-day, though the MACD histogram is starting to show a little weakness with the light volume here. And then IWM, the MACD is definitely rolling over and is close to a red arrow, but still easily above the 8 days. So break the 17, especially with such a big gap there. Now we're talking about something to the downside. Until then, this is nothing. Like that, as bad as that looks, it's nothing yet. It can turn into something, but not yet. There's your S&P back below 40 on the DMI, back below its ADX, so you're back to convergence mode. It doesn't turn into divergence until the negative indicator at least gets above 25. On the Qs, it's above 20, so it's, and again back below its ADX2. So you're showing some convergence here. Convergence, remember, means you're still moving in the direction of the trend. You're just doing it at a much slower pace. A consolidation is when you move, obviously, in the opposite direction of the trend. So not quite there yet on that. When you look at some of these other oscillators too, like the RSI and the CCI, for SPX, you're back below 70, still bullish, not as extreme. You got that divergence on the CCI to watch for if we were to break zero, which we haven't done for a while. Let's look at the Ichimoku cloud for SPY, well above the cloud. The Qs, not necessarily. Here. The Qs, not necessarily, but the SPY, still very, very strong trend, above 8 on the trend quality. So again, remember, we're not really too concerned about things turning around until it busts down to zero, right? And usually that means both these indicators bust to zero, and usually that means we're breaking below the blue line there. So we're not there yet. On this, we're flirting with we're still in the upper reversal zone on the stochastics, but we're flirting with getting below the moving average. The whole is still pretty bullish, though the weekly chart, remember, we're not like, we can flip that very, very quickly, and we have been bullish. Has it been 20 weeks now? We've been see, not quite here, but 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6. So we're at 16. So we're not quite at 20 weeks. Again, on a 20 period moving average like this, that's kind of when you look for it to end, at least from a long-term standpoint. So we're not necessarily there quite yet. So not a huge concern. The McClellan oscillator is showing some weakness. So we got above 500. That's a good sign. We're still not anywhere near some of these other peaks that we had. In fact, even the August peak so far is still higher than where we're at here right now. And of course, the February peak was much more broad in the move than what we're seeing. So we're not quite there yet, and we're below. At least we're not below zero. The money flow is dropping down. One interesting thing about the money flow, if you look at, if I were to zoom out, I was sharing this with my class in technical analysis today. If you were to look at here, the last time we were at this minus 800 level for money flow was back in the September 21st time frame. So September 21st, you can see we were trading at 377.5 roughly in that area. So the money flow index is just barely got, or the money flow again, not the index, the actual money flow, which is basically the volume normalized for the price at the time. Generally, almost always is at the level before and can exceed that level before the money flow itself can get up to higher highs. But that hasn't been the case. Like if you notice through much of this correction, like here we are back. We're pretty much at these high at the early April highs of last year, coming right off of that. We're about at the same level. But if you look at where we're at on the money flow, we're nowhere near that level. That is not normal. On most of the other corrections, even the bear market lows, you are generally, when you get back up and you're back to these, the similar levels during the correction or even before the correction, the money flow is either going to be either at the same level or already above it. Even the COVID low, we were right back up. By the time we got back to the COVID high, the money flow was back to the same height, the same level. This has not been the case. In fact, when you look at, like, again, where we're at right now, September 21st, which is right here, this is where the money flow was at on September 21st, right in this area right here, minus 800. So we are back to that level now. If you look at the index, though, the price of the index is way up above. Like we didn't have very much left of the correction. We hit the October lows, mid-October lows, just a few weeks after. But you notice, though, as we got progressively higher lows going into the end of the year, beginning of this year, the money flow actually kept going down. And is only now since been rising, but it's so far behind the curve that it's the same thing happened as we approach this August peak. The money flow was nowhere near the same levels as it was before, and the March peak, the money flow was nowhere near the same levels it was before, and that was a big red flag for when we talked about it back then. It's an enormous red flag right now. The fact that the index itself is so much higher than 377.5, and we're just barely getting back to that level, is just a big red flag, and again, another sign that I think that this correction bounce ultimately won't get, ultimately will fail and produce a new correction at some point, which could ultimately lead to a bear market. Very similar, if you look at the Qs, and we'll talk about that in a minute. Let's finish with the VIX and some of these other charts, and we'll get into the rate hike cycle. We've gone a few days without a new high, and you notice the green line. Remember, we don't have to worry about the reversal until we drop below 70, and really too, until you get a decent decline to the downside. We still haven't had a 1% decline to the downside, as bearish as we were today on the S&P, or yesterday, excuse me. No, we still didn't have a 1% decline. It was barely more than a 0.5%. The Qs is a different story. The Qs had a little bit more of a decline yesterday. We had almost a pretty significant gap there, and we did kind of run away. We did kind of run away from the opening gap. So the Qs, you could make the case that it would have been better if it was a bigger gap, but you could make the case that was a runaway gap, which could be the start of an intermediate decline. So that's again, you have to wait for this to get below 70, and last time it got all the way below 30 and still didn't produce a decline, and we'll see if that ends up being the case this go around. Of course, when you look at the volume and the trading range going into expiration, no less, the range was pretty small, not very much of a move whatsoever. In fact, SPY ended up flat, perfectly flat, 2 consecutive days of closing at 452.18. But they look at the range, way low, almost as low as it was yesterday. Yesterday we were at 3.66, today's 2. So extremely low ATR, and the volume you can see was not was a little bit below what is a pretty low average. So you continue to get the range. At 2%, the range, or 2 points, the range was way below this. Again, going into an expiration where we've been parabolic to a degree, not as parabolic as we were in June expiration, but pretty parabolic there. And then you see that for the second consecutive day, with the markets kind of down, the VIX was down for a second straight day. The VIX was down almost 3%. With the VVIX staying up a little bit. You still have a very low positive correlation with the VVIX, the VIX and the VVIX, which has led to the VIX correcting up to where it should be based on where the VVIX is saying it should be. And of course, we've talked about how low and how compressed the VIX is, and how next week is the seasonal low that precedes a 3-month move higher in volatility through the month of August, September, and October, all the way to the first day in November. So we are heading into a seasonal low with the volatility index at extreme lows. Whether, again, you're looking at the compression, whether you're looking at its correlation with the VVIX, whether you're looking at its ratio with the VIX 3M, the 3-month VIX, whether you're looking at how low you are below moving averages, we're extremely low. And we're setting up for that. So coming out of expiration this next week with big earnings, with the FOMC, again with CPI, an important CPI data point coming out in August. Next week's got some potential to be more volatile week than maybe what we've seen in a while. We haven't had, if you look at that daily change, we haven't had a down week, or at least a significantly down week, a 2% or more down week, since all the way back in early March with the regional banking issues. Right, that was the last time, and of course we were down 4.5%. I don't think we're going to have 4.5% again here but I definitely think that we're, a 2% or more decline could be on the table next week if, again, the market has a negative response to all these things. Again, the FOMC, the earnings announcements. Of course, we could bounce back up to another 2% higher, but I think it's more likely we probably start the consolidation here to some degree next week. It might not. It might be it might be another 1% move to the downside, but that is more likely than getting a 2% or higher gain to the upside based off of what we're seeing on these different charts. All right, now let's take a look at what's driving a lot of this price action. You can see the gains. I mean, this is why the Qs are struggling right now. Their gains are so outsized. We talked about all week going into this Tesla earnings, Netflix earnings, kicking off this cycle of earnings this season. Their returns are so extreme to the upside. I tweeted that out too. I think we talked about that on Wednesday's Market Outlook. That again, it would have taken, these stocks are pretty much priced for perfection. You hear that a lot today, and I agree. And now the markets, and now people are taking profits on those stocks that rallied the most. You can see the Qs are down today, along with IWM, both of them dropping down. Emerging markets also struggling despite strong commodity price moves. Commodities were up despite a strong dollar. The dollar was up today. That pushed gold down, but it did not push real estate or commodities down, real assets here to the upside. That was just today. If I were to zoom out to the whole week, you can see commodities finished the week as the best performing asset class. The weakness in IWM was because it was the best performing asset class for most of the day, for most of the week, before falling here at the end of the day. The dollar had a resurgence, a big strong move the last couple of days, really the last 3 days. The dollar ramping up pretty strong. Again, that puts pressure on the Qs, the strength in the dollar. Obviously puts pressure on emerging markets as well. They were down, and not very much. Again, we're looking at that 1, 2, 3% declines. I mean, it's only a 1.66% decline, but commodities were up almost 2%. That's one of the bigger weeks, bigger moves for commodity prices that we've seen in a while. Here, we've had multiple weeks in a row here. 4 out of the last 6 of strength of commodities, and look at what it's done to the chart. When you look at the chart for commodities, you're above the 200-day moving average, so you've completely filled in that gap. Now there is resistance here. The moving average itself, the volume node, there is some strong resistance levels, and you look at where we are here. You're easily above the 30-week moving average, filling in the gap between the 30 and the 50. So, and I talked to you before about the bull tag that it got. You have dark green shading, a green line on its daily chart, but you got a bear tag, last week on commodities, and you're following through with that now up over 2%. More above the moving average than we've seen, right? The last bear tag didn't get that high. So we followed the bear tag up with some more bullishness. Again, the last thing in this inflation narrative needs to see is a renewed strength in commodity prices back up to the upside. It's the intermediate line crossing up above its market sentiment for the first time since this whole decline, again on the weekly chart. So, I mean, day to day, there's going to be ups and downs, but kind of on a long-term basis, you can see the renewed strength in commodities. The dollar also had some pretty good strength. It was very oversold. We talked about that last week. It was extremely oversold last week. It did rebound, like I said, over the past 3 days, quite a bit. The near-term line jumping up as much as it did. It did end up, you can see, after getting a pretty strong candle last week, bouncing back up. Again, one of the bigger moves to the upside that we've seen on that chart. When you look at the moving averages here for the dollar, it did get, at least is flirting with the 17-day moving average as the MACD and stochastics cross above their moving averages. And as of right now, holding these lows. I mean, we didn't break below those lows, but as of right now, holding them. If you look at the actual futures, the index here, it did break below those lows. UUP didn't. But DXY did. It got down to 100, and as of right now, holding 100 as a as a support and bouncing off of that. And again, next week, really important. Do we get back below towards these lows, or do we get back up above 102? In which case, it would pretty much say that this week was a breakout or a fake out, which would be worse than support holding, right? It'd be, a fake out suckers in a lot of people, dollar bears, and then getting back above, that old support nullifies the breakdown, and now you have a lot of, FOMO traders essentially caught in what they thought would be a new bearish move to the downside because they missed on this bearish move, so they thought, oh, we'll get into this one, and that's how fake outs work from a psychological standpoint. Long-term bonds is the other kind of main story here. You can see it's been really, really bearish. Let's go back to the market forecast. They've been really, really bearish, kind of, sideways for the last, 6-8 months or so. Intermediate, sideways enough that the market sentiment's been dropping, or bearish enough, and a little bias that the market sentiment's been dropping, but intermediate lines above the market sentiment, flirting with getting into bullish territory there. Here's the weekly chart, and we did have dark pink shading and a red line. You can see over the past, 8 weeks, 10 weeks, the intermediate line, which was on the cusp of getting in the reversal zone, failed and came back down to where the market sentiment line is. But now you have your short-term sentiment bouncing back up. So we've had 2 consecutive weeks of rallies in bonds. So you kind of keep your eye on what it can do back in the middle of its bandwidth there from a brief move below the lower band. And then if you look at the dollar index, again, after getting way below the bands, and this is what we talked about last week, getting way below the bands there, bouncing back up as well out of the lowest quartile, back up to the midpoint of a pretty wide band width, which means you're due a lot of volatility, and you can see the momentum, which is pretty low, has bottomed out and is now rotating back up. So there's some opportunity here for the dollar to, if it were to get back above these levels, 101 or so, and basically say that this last little move was a fake out, especially if we get to the point where yields start to ramp back up. So the 2-year is not quite back to 5%. It's up to 4.85 though, so that they've had a pretty good week here from that standpoint. Get it to the 5-year chart. There we go. So we've had a pretty good week from that standpoint there. I guess you probably better look at it on the 1 month chart would be a good way to look at it. There we go. So if you look at here, so where we were on the, come on. There we go. So back on the 14th is where we finished last week. So you can see we've gained about 10 basis points in a week on the 2-year. The 3-month has been flat. And of course the 10-year, in fact, the spread between the 10 and the 2-year did drop back down below 100 basis points. It ended up finishing the day, right at 100 basis points. Again, the last 2 times we got below 100 basis points, the yield curve rebounded pretty significantly. And an inverted yield curve is not a bad thing. It's when the inverted yield curve starts to uninvert that's the bad thing. Of course, next week, and I'm not going to be here at all next week, so next week we have the FOMC. The FOMC meeting is widely expected to raise rates, but it's also expected to be the end. You can see the November meeting where they would have the next rate hike, since they're in the mode of skipping right now. You only have about a 30%, a little less than 30% chance of a rate hike. So that's a pretty decent probability. It's not 0, but it's also still very low. So the market's pretty much, and the bond market too, as of right now, is pretty much pricing in that the rate hike cycle is ending here in July. And then as of right now, the rate cut cycle had been slated to start in March. We had, an 85% probability that the rate hike, a month ago, that the rate hike cycle would start in March. Just as of a week ago, you were at about a 70% probability of a rate cut in March. That's come down to about a 60% now. So you're roughly right about 60%. That's still high probability. So that's going to be a really important thing to watch over the next week or two, is when that rate cut cycle starts. Because that could, at one point in time in December, a month ago in December, you were looking at about a 40% chance of a rate cut from from what will be next week's level. We had pretty decent odds of rate cuts by the end of the year, more than likely going to be next year. So how does that favor? I wanted to show this NASDAQ, the returns on the NASDAQ. So let's go back to this zigzag chart. So the last rate hike cycle where the Fed really raised rates, as strongly as they did this time, not counting this 16-17 cycle where it was like one rate hike in the fourth quarter of 16, and then three rate hikes in 2017 out of 6 meetings. So they were skipping rate hikes, then they really skipped from June to December for that third one. So that really wasn't a very consistent rate hike cycle. The last rate hike cycle before that was back in 04-06, where they were raising rates pretty much every meeting, at least 25 basis points, to help cool off that housing market. Well, if you look at the NASDAQ 100 during that rate hike cycle from 04-06, so here's where it started in June of 04, and then it ended over here in June of 06. It's actually a little bit up here. This was July. But you can see the NASDAQ pretty much ended up being flat. It kind of peaked there in June, and then it finally bottomed out there in June of 06. So you had ups and downs, but you pretty much ended the whole entire rate cycle flat. As of right now, this current rate hike cycle, we're not necessarily flat. It started over here on March 16th. So right about here. So we're up about 2,000 points. So that's sounds like a lot. It's not on an index that's 15,000 points. So, but it's still pretty decent. It's a little bit more than 10% return. But again, ups and downs, and you could argue mostly flat considering the volatility of the last couple of years. And during each of those rate hike cycles, and in the case of 04-06, it was a little bit afterwards, the NASDAQ 100 tested the 200-week moving average. So we had a correction during each of those cycles. Like I said, it was a little bit after in 04-06. Let's go to the NASDAQ 100, and you can see way over here in 06. So there's the move, kind of a little, like I said, towards the end of the rate hike cycle. Then it finished a little bit after, and then of course, the big correction we saw last year. By the end of last year. So similar patterns, right? And then what you see another instance here of another similarity is as we are at the end of this rate hike cycle, and looking at how life will be after it's all over, you've had about a 40% run off of those lows, off of the low point that tested the 200-week moving average, right? So we had tested it over here. We've had a 48% run. If you look at, again, 04-06, same thing happened, right? You had here we go. So off of the low point that touched the 200-week moving average, we had a 41% rally without a 10% decline, right? All of these, you don't get the red box until you 10% decline. Then you had a pullback, right? And then after the pullback, the Fed cut rates, made one last hurrah, and then the bear market started. So here we are again, 40% plus move without a 10% decline, coming off of the touch of the 200-week moving average. The Fed's likely to cut rates relatively soon. There was a pretty big gap over here. There was a gap from June 06, right over here, June 06 to September of 07 when they cut rates. So you're well more than a year, about 15 months. The market's not expecting a 15-month gap between last rate hike and rate cut. If this is the last rate hike and the first cut's in March, you're looking at about 9 months or so, 8 months, 9 months. That's not very long. So if the market were to start to consolidate right now in a a seasonally bullish time of year for volatility, with volatility as low as it is. Again, even bigger run than what we saw back then, 48%. That's a big number. That again, not fueled by any kind of QE or any kind of a little bit of liquidity from the banking issues, but no specific asset purchase programs. Obviously, no interest rate declines. So there's not a whole lot of fuel to that fire, yet the fire still ran really, really hot here. So let's say you get a consolidation down towards this 1430, 330 level, which if you look at, that would end up being about, from the high point here, about 15,950 or so, would end up being about a 10% decline. And then you start pricing in the rate cut, if and when that, depending upon when that would happen, maybe March, maybe earlier, if that 10% decline starts to move up the odds of a rate cut to even earlier. Or if the decline gets a little bit bigger, maybe it drops down to the 50% retracement before rebounding. And then you start pricing in the rate cut with some bullishness, because that's the bullish narrative, is the Fed might start cutting rates. That's never been bullish in the past, but for some odd reason, people think that will be bullish now. And like we saw, the NASDAQ made one more higher high in 06, 07 with that first rate cut before things hit the fan, which is generally what happens as the Fed is cutting rates, is things are hitting the fan. That's generally why they are cutting rates. So you kind of see a very similar scenario playing out now that we saw in 04, 06, with that last kind of consistent rate hike cycle, similar to what we've seen here. So very, very important week next week, and really important to see what the Fed, if the Fed starts to take off the gas, or whether they start to ramp up the expectations for that last rate hike, which could be the catalyst for this 10% plus, or plus or minus whatever, consolidation. And then we'll see if the market starts, how much. The leading indicators, the conference board said that they're expecting Q3 into 2024 recession to be starting here anytime between this quarter and the next quarter or two. So if that does start to happen, we start to get more signs that the recession is starting. The Fed, that would be the only way the Fed cuts rates. Then you can see how things can transition towards a parabolic bullish market to ultimately a break below that 200-week moving average, which defines a sustained bear market, not just a big correction because of there was such a big gap between the 50 and the 200-week moving averages. So that's all on the table. I think there's by the time I get back the following Wednesday, late Wednesday night, so I won't do another market outlook until not next Friday, but the Friday after that, 2 weeks from today, is when I'll do the next market outlook. Things could be really interesting between now and then. Hopefully we just grind higher and we just continue to converge, like we've talked about before. But if but I don't think so. I think the next couple of weeks might be more consolidation. We might actually be in consolidation mode. I don't think we'll be in full 10% mode, but we'll be working in that direction by the time you hear from me again over the next couple of weeks. All right, let's take a look at our trade idea for today. And it's actually on Tesla. Tesla obviously had its earnings earlier this week. Big drop yesterday. In fact, that gap, if you look at the move here on the earnings announcement, we had a pretty decent gap to the downside. You see this gap. That's a pretty decent sized gap. In fact, when you look at it on this basis, Tesla, almost 2 standard deviations, way more than 1 standard deviation for the past year. So a good sized gap to the downside. As you can see, one of the bigger down moves that we've seen, down what ended up being almost 10%, 9.7%. There was a 9.7% back there in April, exactly 3 months ago. And then you can see some of these others during the correction. So, and that was a much bigger gap down there in April. We were down, you started the day down 8% and you only finished the day down 9.74. So a little different scenario this go around. Here's the chart, and let's go out a little bit longer so we can see that April 20th gap to the downside which is right over here. So there's that earnings. So not quite the same runaway gap that we saw here. So we kind of stabilized, and it was a little bit lower, but most of the losses occurred overnight. Not the case yesterday. We gapped down, and then we ran down, and then we continued down, and we finished down. So it had three. I mean, there's a lot of characteristics of a runaway gap there. Obviously now, when you look at the market forecast chart, we got a bull tag. So again, a bull tag means that you close below the 30-day moving average, while the intermediate line is light pink shading. So it's down, but just barely below 80 at the 78%. But you notice it's also breaking below the market sentiment line, which typically signify, the bull tag can signify the beginning of a bullish intermediate run, as can that runaway gap. You are breaking the 23% retracement, which means the retracement is starting, and you have the weakest short-term sentiment that we've seen in quite some time. The stock is now 2% below the 30-day moving average. When you look at the weekly chart and you say, okay, well, what kind of weekly candle did we get? We ended up with a pretty significant transition candle. Last week, we went from, we kind of had equal highs, slightly higher highs, and an even more slightly higher close, so barely higher there. But then this week, a significant transition. It's a big range, obviously with the earnings, and then a small body, lower close. And if you look at, remember, they can be more bearish when the actual candle on the transition is bearish. See, that last transition candle wasn't very bearish. This one, much more significant to the downside. Obviously, you've got 3 red arrows now on Tesla, and that wasn't the case before. You had it, actually yesterday was a 3 red arrow signal, above average volume on both those days. Looking at the breaking these lines up, you can see again you broke below the 17 and the 30 here in the last couple of days as we head into expiration. MACD is below its moving average, close to dropping below 0. Stochastics is also dropping down as we are above the value area. Looking at the DMI, you can see we were flirting with a cross for most of the day. It looks like we actually finished with the cross of the negative above the positive. So we'll see if that ends up changing. The ADX is still very high, which means you can still get pretty volatile moves in either direction right now, especially with the bandwidth still actually outside the Keltner channels. So you can see the Keltner channel, bandwidth outside the Keltner channels there. You are in the lower half of the range, flirting with getting into lower quartile, well above the value area. So, again, this is the kind of scenario that you can get some significant moves, like I said, in either direction. Obviously getting out of bullish territory from being extreme. Big divergence on the CCI that you've already broken below the low point in between. So that can suggest a trend change. Dropping all the way down to minus 150. The Ichimoku cloud, obviously it's a very strong trend still, hasn't broken down to 0, but you are below the blue line easy, way above the cloud, and you have the negative rate of change developing, barely, you're just barely positive here, so you're almost at that negative level on the rate of change. So there's an opportunity for a directional trade. So what I decided to do was to come out to the August expiration and do a long put vertical spread, not too aggressive. So we didn't go at the money. In fact, we went and sold, or bought. We actually bought at the mid 30s delta, and then sold one strike away there, and the stock is down a little bit since we got into it. Let's go single symbol here. Just a smidgen. The stock is down just a smidgen since we got into it during the Market Outlook live session. Here you can kind of see, not very much, but just a smidgen there, and enough to bring that delta from where it was in the mid 30s to about 38 now. And of course, I sold one strike away for protection. I ended up position sizing around my normal directional, half my normal risk, which is typical for low probability directional trades. Getting about a 2-to-1 reward to risk ratio. A lot of flexibility here because, again, it's still a very, very strong trend. But if you look at, 245 is where it's got to get down to. If you look at where the for Tesla here. Let's go Tesla. Where the 1 standard deviation is all the way down to 221, where the value area is. 245 is way up here. So if it were to test that 38% Fibonacci retracement level, which is close to getting to now, and break below that into this area, then that kind of gives us, then there's plenty of room for it to do that. Like I said, a lot of flexibility built in. Then that's how we end up getting a maximum gain with, again, a pretty small risk, not very much of a risk to the on this trade as our maximum loss is half what our normal risk is. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up in a new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Follow me on Twitter and Facebook and like our posts there. Again, I won't be back on until 2 weeks from today, so have a great couple of weeks here. Cross our fingers the market behaves, and we'll see you all next time.